Hey there, YouTube family. It's Josh with Stocks with Josh, and today I'm going to talk to you guys about how to make money in an all-red day, in a bear market, recession, depression, crash, apocalypse. Fed decides to raise interest rates by 2% and shock the world. We're talking today about shorting stock, okay? Shorting stock is not really a beginner trader's topic. It really has traditionally been for advanced traders because there is more risk to shorting stock than simply purchasing a stock. I'm going to talk to you guys about those risks, the mechanics, and the rules to shorting stock. I believe that it will make you a smarter investor. Even if you don't short stock, it's going to make you a much smarter and informed investor. Before we begin, please hit that like, the subscribe if you want complex subjects broken down to you guys daily soon, right now every other day, and the notification bell, as well as throw in a comment in the comment section. Anything I say is not a suggestion for you to buy, sell, or hold. This is for educational purposes. Okay, let's just talk a little bit about how shorting a stock works, okay? So what it is, let's say that I think that Apple is going to fall. It's going to fall from $100 to $60, okay? So I go to the exchange and I borrow a share of Apple at the value of $100. Now, the very first thing I do is I immediately sell it, and I basically hold that $100 in my account. Now, I sit back, and the market continues to fall, and Apple goes from 100 to 90 to 80 to 70 and eventually to 60. I say to myself, there's no way it's going to fall any further, so I better close up this position, and I better get that share back to the exchange. So then I go with that $100 that I've essentially got on hold in my account, and I buy that share at $60. Okay, I keep the 40 bucks that's in my account as profit, and I give the exchange back their share of Apple. That essentially is how money is made shorting a stock. Okay, let's talk about what happens though when Apple goes up in price and not down. So I start off, I borrow my share of Apple from the exchange. I agree to their percentage rate for borrowing it over time. I immediately sell it. Now I've got $1,000. I've got $100 in my account, the value of that one share of Apple that I sold, and then Apple goes to 110, 120, 130, 140, 150, 160. And I'm thinking, you know what? This thing is not coming down. I'm paying a percentage to hold it. I better close out my position. But all I have is the $100. So now I've got to add an additional $60 of my own, and I then go and buy the share of Apple on the open market at 160. I return it to the exchange, and I'm out 60 bucks. That's essentially how shorting a stock works. So what are some of the rules to shorting a stock? Okay, you've got to have, according to regulation, you've got to have a minimum of $2,000 in your account to be allowed to short, okay? But in addition to that, the exchanges have a rule that says that you need to maintain 150% of the value of any trade. So for example, if I had $2,000 in my account and I decided I was going to take a $1,000 short position on Apple, I would need to have a buffer for that trade of $1,500. Because if the scenario occurred where the stock went up rather than down, the exchange wants to protect their money. They want to protect the shares that they lent to you, and so they won't allow you to trade the additional $1,000 that you have in your account. They're essentially going to put on hold 150% of the value of that trade. Okay, you also cannot short stock in every exchange. Robinhood doesn't allow short selling. Neither do any accounts where taxes are withheld, like traditional cash accounts or Roth RIAs. Those are basically some of the rules. What's the difference between shorting a stock and buying a put? There's a massive difference. Both a put which is an option, right? A put option that you buy, which makes you money if the stock goes down, and a short, they both profit when the market's going down, but there's more limited risk to buying a put option. The only thing that you can lose in buying a put option is what you paid, the premium, to the stockholder. Okay, so I'm not going to break down options for you guys today, but a quick explanation is that when you buy an option, you're simply paying the owner of the stock what's called the premium, right? It's a value to purchase a contract which allows you to buy or sell the underlying stock that they own. And that contract that has a price associated with it, that price associated with the contract is what you can lose if the stock never goes down in value. So in that scenario, if you bought a put contract on 1,000 shares of Apple, and the cost of that contract, let's say it was $100, if the shares never dropped and the put eventually expired, because options are time sensitive, then you would lose your $100. Okay, and that's not good, but let's talk about what happens in a situation of shorting a stock and it goes up. Technically, you're exposed to unlimited loss. So if I bought $1,000 of shorting Apple and Apple just went through the roof, the first thing that's going to happen is the exchange. I'm going to not be, depending on how much money I have in my account. Now, if I bought 1,000 shares of Apple, shorting it, and I had millions of dollars in my account, they'd probably let me hold it, right? But if I only had $2,000 in my account and I bought 1,000 shares of Apple and I went to short it, but it went up exponentially, then after I get over that 150%, remember I have to have 50 extra percent in the account for the trade, they're going to give me a margin call. If I don't respond to that margin call, then they're going to close out my position, right? Which means they're going to buy it for me. They're not going to give me the time to hold it anymore. And they're going to then tell me they're just going to take that 1,000 plus the 500 plus the fees associated with borrowing that stock, okay? So there have been people that had accounts and there were stocks that they shorted and there was a short squeeze. You guys have all heard about this through AMC and GME. There was short squeezes and the stock went up hundreds of dollars and the exchange was not able to respond quick enough. And so when they closed the person's position, the exchange was out hundreds of thousands of dollars. Now what they do is they will send you the bill. So even though you didn't have the money in your account to cover it, by the time it took them to close that trade, you owe all that money. Even if the stock ended coming back down, wherever they closed it is what you owe. And so this is the main reason why people are typically fearful to short stock, and they don't know all the rules, they don't know the parameters, they don't know how the exchange will react when it goes the different direction than they expected. But there is easy ways to combat this. And if you're disciplined, all you have to do is put in a buy stop order. It's no different than a stop loss order. But I will tell you, there's a lot of people, when you go to long stock, you don't have to worry about it. If you're an investor and you want to hold it for a year, 2 years, 3 years, 10 years, 20 years, it's no stress to you. There's no cost to do it. Once you own it, it's yours. You can leave it sit in that exchange and never pay the exchange a penny. But the minute you short a stock, you could say that a ticker, a clock has hit and it's ticking away. And every bit of time that goes by, you're paying something to borrow that stock. And if it doesn't go the direction that you want it to go, then it can really get out of control quickly. The exchange will respond and you'll be on the hook. Now, if you have your stop limit buy order in, you're fine. You'll get right out of the trade if it were to run up, and you would make money if it were to drop. So this is not impossible to do. I want to briefly talk to you guys about AMC, right? and GME. GME did have a short squeeze. You had a stock that ran up into the hundreds of dollars, which shocked everybody. Nobody was prepared for it. All the buyers came in and ran it up. And the people that had planned out that short squeeze knew that the short interest was very high. You got to remember that the only way the person who is shorting the stock can close their trade is by buying the stock. And so here's another one of the risks associated with shorting versus going long. When you go long a stock, you are working, everybody's horizon is different. There is essentially, it's not a crowd activity, it's an individual activity. So yes, things can move everybody to respond at one time, but for the most part, someone will hold Apple for a day, a week, a year, 10 years, or 20 years. They don't often all move as a group. But when people are shorting stock, it sort of consolidates all the traders into one goal. And that's where you end up getting the short squeeze, because you've got everybody who's trying to funnel into or out of their position at one time. It's just not possible. And if you're last to the party of closing your position, then you're going to end up, it's going to drive the price up, because remember, the shorters are buying it to close their position. It's going to drive the stock up, and instead of you making money, the stock's going to run up and you're going to lose money. One of the things I talk to you guys a lot about in regards to everyday trading is when stocks are going down and people are shorting those stocks. I always try to remind people, you get these big giant bounces on stocks because they are being shorted, and everybody at one time tries to close their position, and they can run up a stock up, let's say we're talking about a penny stock and we're at 40, 50, 60 cents. It can run up to $2 to $3 just because everybody who shorted it is trying to quickly close their position and take profit, but not everybody can take profit at one time because of the float and how many shares people are buying or selling, and that's what drives a stock up in price. Okay, a couple other rules. You can only short a stock when it's going up. So if a stock is dropping, you actually have to wait for it to tick up. So let's say that Apple started dropping, had really bearish news, and you thought, oh, I'm going to jump on and I'm going to short it. If the stock is going down in price, the exchange will not allow you to take a short position. It has to tick up, even just for a moment. And as soon as it stops falling and it ticks up, then you can enter a short position. So I don't want to give you the impression, you might say, well, why, if the markets are falling terribly, doesn't everybody just pile in and short at that point? Well, there's a regulatory rule that prevents that, because it would cause overly dramatic downward movement. If everybody could pile in and go short, it could just crash the markets. And so it's called the Uptick Rule. It basically is where you have to have that stock has to stop falling, it's got to recover slightly, then you can enter your short position, and then often it does continue to fall. So that's a little bit of a rule. I mentioned to you guys, you can't short on Robinhood. You can short on moomoo and Webull. Right now, the exchanges are fighting for new customers. If you don't have either moomoo or Webull, it's time to get them. You can get them in the link of the description of this video, are two links to both moomoo and Webull. With both of them, if you put $100 in, you're getting guaranteed money. You're getting a guaranteed share of Lucid. Pretty much for $100, you're getting $60, but you're also getting the opportunity to get up to $25,000 worth of stock. But I keep getting this question in the comment section. People are saying, hey, I got moomoo, but I didn't get my free shares. You have to claim them. Go under the Me button, go to the Promotions button, and there's a section where you can claim your free shares. Don't lose out on the free money, family. Okay, so we talked about, I wanted to talk to you guys about why AMC has never squeezed. I've gotten that question before. I will give you guys a brief comment that AMC has continued to fall. I think the last I looked at it, I saw the range being between $8 and $14 as a possible trade. But after the GME situation, the GameStop situation, the exchange was caught by surprise. You have to understand, they don't have to buy the shares if they don't have to buy the shares, okay? So remember what I said to you guys about your account. If you had bought 1,000 shares of Apple, right, but you had millions of dollars in your account, and Apple then went up $100, $200, $300, $400, as long as you had the ability to continue to pay that interest rate to the exchange, and as long as you had the value of that increase sitting in your account as cash, they'll let you hold it. And I think that's what a lot of people were taken by surprise when AMC never squeezed. When GameStop squeezed, it was because they were unprepared. They didn't have things set up the way they needed to have them set up. But as soon as they saw it happening with AMC, all that initial run-up was, it might have been a squeeze of the retail shorters, but after that, the exchanges were not forced to close. They prepared themselves. They made their handshake deals in the dark. They made sure that they were cashed up, and they put themselves in a position where they were going to outweight the shorters of AMC. Now, I don't know, I might get a bunch of comments in the comment section, just slamming that and saying it's going to squeeze. I think the only squeeze potential that people are going to see on AMC is the potential for the retail side to get squeezed, the retail shorters, not the institutional shorters. So I just want you guys to be aware. That's my opinion. You guys do your own thing, do your own research, do your own due diligence. I've traded AMC when I saw it come into a buy zone. I've shared those trades with you. They were profitable. We called it perfectly. So, okay, last thing on the list, should I short stock? I'm going to tell you that if you don't know what you're doing, you shouldn't. If you did choose to learn to short stock, and I'm going to share more videos on this, I'm even going to share step-by-step how to do it, and I'm going to show you some stock that I'm shorting. I'm going to do that in time, okay? But I'm going to tell you guys that, one of the highest recommendations people will say is to paper trade. You can trade just in paper alone with no money at risk in your account. You can do that in moomoo. You can short stock paper trading in moomoo and have no risk. We can do it as an exercise. Most people just don't like to do that. They want to have a little bit of money at risk. I've personally found that when I've got money at risk, it causes my eyes to sharpen. It causes my rose-colored glasses to come off. I don't know if you ever heard that term. Rose-colored glasses means that you just look at everything as rosy. And when you're first looking at a stock and the possibility of making money, but as soon as you put money in, those rose glasses come off, and all of a sudden you see all the problems with the idea you had behind your trade. So I do like to put a little bit of money in, but I think that if you would consider shorting stock, you can only do it with money you could absolutely afford to lose. And I personally would recommend doing it with like $10, really small sums. But I'll tell you this, one of the biggest advantages that I gained in learning to short stock was seeing stock from a different perspective. When you have eyes to see profit for it to go down, it changes your view. And when you're actually shorting a stock as it goes down and you say to yourself, you know what, this is as far as it's going to go. I'm going to get out of this and I'm going to take my profit. That's often the perfect time to go long. So shorting stock can be great on perspective. I'm going to cover this topic some more. I hope all this helped you guys. If you have questions, throw them in the comments section. Appreciate you guys letting me be part of your financial journey. Have a great day, and I'll see you all in the next video.